All right, everyone. So today we're going to be talking about stop loss placement and trailing your stop as far as risk management goes. We're not going to be going too deep into risk to reward numbers, but we are going to be going into some interesting topics. And we're going to be talking about tracking data for the following: MAE, order block mean threshold, fair value gap measurements, stop placement, and risk to reward, and how we can apply this to our current trading system, model, etc., and how we can use this to improve our stop loss placement and ultimately improve our risk to reward. It is important to note that some of us may have different models, different systems with different outcomes, of course, that give us different risk to reward ratios. But at the end of the day, I do believe that with tracking all of the right data, you will come to a successful conclusion and approach to improve your stop loss placement and therefore your risk to reward finds improvement as well. So let's get into the first one. Maximum adverse excursion. So what is MAE? MAE is a basic stat. It basically measures the largest drawdown point during an open position. So for longs, it's going to be the lowest price during. For shorts, it's going to be the highest price during. And then what we're going to do with this is that we're going to collect data for an average, right? So let's say that we use an order block or in this case, a fair value gap for an entry point. As you can see, our entry point was a little bit higher on that fair value gap. But because we are studying our models and we do backtest our models, then we're going to be tracking all of this data and we're going to calculate the MAE. So what we're going to do is that through historical numbers, we're just going to find an average and we're going to look to pair the MAE, our average, which would be our average drawdown, in our trades. We're going to look to pair that with a fair value gap consequent encroachment or an order block mean threshold, or maybe an array that we find within our positions, or that we find within the trades, or maybe a specific array that we find while we are backtesting and collecting our data, right? So it is important to note that how far does a trade go against you, right? Because if it goes against you a lot, then you might want to ask yourself, okay, if I'm seeing a really high number of MAE, if my MAE average is incredibly high, then there must be something going on with my entry point, right? We start to question these things. It's a basic statistic, but ultimately, surrounding it, you want to ask yourself, okay, if my MAE is high, then how can I improve my entry point? So that means that my entry point can be improved. If your MAE is low, then that means you're doing pretty well, and that the place where price reverses or finishes its retracement from is near the price where you are entering, right? So ultimately, we collect this information from our back tests. We use one PD array or whatever the model it is that we're using, and then we find that average. And if it's high relative to our time frame model time frame, sorry, then we would look to improve upon that, right? If there is maybe a rejection block lower that you could use for a lower MAE, or if there's an order block that you see that you might find during your backtest session, instead of using the fair value gap, you might find more success and a better risk to reward just by finding the data average of your MAE, right? The next point is going to be the order block mean threshold. This is more of a universal approach, but I do use this on a pretty much everyday basis, right? So in the case where we're using this array for an entry, because for me, an order block and the fair value gap are the two most used arrays, we keep track of the mean threshold and watch for body closes above for bullish order block and below for bearish order block, right? So majority of the institutional volume is found within the body of a candle. And so by this logic, when we're under the correct institutional sponsorship, the order block mean threshold should be respected, right? So if we're using a higher time frame order block, then we're going to go on a lower time frame, and we're going to seek for specific reactions, right? Because while we're in a position, we want to demand price. We can't. It's not obviously going to act exactly how we want it to, but there are certain criteria that we want to keep in mind when we're in a position that we'd want to see for a continuation. So for a higher time frame order block, we watch for lower time frame CSDs near the mean threshold in the case where it does retrace, right? So what we would do is that we look at the open price of the order block, or whatever the value it is that we're using for an entry, and we look for, if it's a higher time from order block, then we look for a lower time from CSD within that place, right? And if it retraces near the main threshold, then we ask of price a CSD. In the case where it does close below, then we might want to consider, okay, price might go against me here, or if there's an array below that could be utilized as well, then we would look to logically frame a way of continuation, right? But we don't want to form fit. We don't want to come up with ideas here and try to convince ourselves that it's going to continue. We have to be aware of what price is doing during our positions, right? So when backtesting, track how many times the mean threshold of your entry order block is respected. This will give you an idea of when you're able to trail or not, right? So when you backtest and you use the open value of the order block, and you start noticing that sometimes during specific backtests, let's say that 40% of the time price goes to the mean threshold, but it respects it. So if you start seeing that from your model, and you start seeing CSDs near the mean threshold, then we can consider, okay, if it's a large body, then we might see a retracement to the mean threshold. Or we look for the kind of order block that we're using, the different specific types of order block, like large wicks, small body, or large body. We watch for the activity near specific values, so open and mean threshold, and then we can make a rule system entry based on the different values of the order block, right? So if we're seeing that during large body order blocks that price retraces to the mean threshold and then CSDs, then we could potentially look for just waiting for the CSD near the mean threshold and then entering upon that. So number 3 is going to be the fair value gap. Creating a fair value gap, we're going to divide it into 4 sections. It's going to be 0, 0.25, 0.5, 0.75, and 1. So consequent encroachment is 0.5, as we all know. It has the same application as the mean threshold, and so wicks are allowed, but bodies are not. In the case where there is an imbalance formation through a swing point, we look for institutional order flow entry grow. So what does that mean? In this case, I use this example. We have this swing high here, order block formation. Price comes down, institutional order flow entry grow. Bodies, respect. So what is the logic behind this? Whenever there's an imbalance created through a swing, price is telling us that there are no pending orders above here. So there is no buy-side liquidity to be paired here, right? And so the imbalance, buy-side imbalance, is telling us that price wants to go higher. There are no resting orders, so price wants to go higher. And so whenever there's, for example, on the 1 minute, I look for these on the 1 minute. On a lower time frame, you would come down and see the bodies respect the consequent encroachment or the 0.25 of the fair value gap, right? So the higher the bodies respect, the more trust we can place in this. And so with the retracement candle, the down close candle that is retracing into, we look for a close above because that would be considered a CSD. And so at this point, if the objective hasn't been met, then we get a CSD. Then we look to trail because this is now an intermediate term low, and then same for the opposing intermediate term high, right? So we divide, and during our backtesting sessions, we look for, if we're using a fair value gap for our entry model, where do we see price respect the most? Where do we see price go visit the most? After a CSD, can I trail? How often will my trail be successful, right? This is something that we keep track of, right? So during that retracement candle, a close above, I trail. It is a backtest. We collect data. Did it fail? Did it not fail? If 70% or 80% of the time that a CSD happens during a retracement into an imbalance and we don't see price come down, then we can consider that as a trail system, right? So number 4, these are all of the statistics that I keep track of. So it's going to be stop loss placement, engine model, and entry PD array, right? Because for different models, we're going to be using different PD arrays, different engine models, and different stop loss placements. Why is it important to keep track of these? You will find different success and different risk to reward ratios with different arrays. That sounds kind of obvious, but at the end of the day, right, if we're using a specific model and we're going to want to stick to that model, then we look for different stop loss placement locations within that model, right? So let's say we're using an FEG plus breaker, right? So where would I consider placing the stop? It would be the swing low, the high or low of the breaker, or the high or low of the imbalance, right? So what we do is that we keep track how often does price visit the high or the low of the breaker? How often does price visit the high or the low of the imbalance, right? And by collecting all this data and reviewing your MAE and your risk to reward, then we look for an optimal stop placement. And then same goes for the engine model, right? So different engine models, if we're naturally more inclined to go long or more inclined to go short, right? Where do we see more success? Do we see more success during offsets, right? If our model includes the use of an offset, or do we find ourselves being more in the first leg of a reaccumulation during an MMXM, right? And so we track how much we risk during an offset or a reaccumulation or redistribution engine model, and then we track our MAE, and then we pair this with the stop loss placement, and then we're able to find a better placement for our stop, right? And then same goes for the entry PD array. So as you can see, when I use order blocks, my average RR with a specific model is higher compared to a buy-side imbalance or a rejection block, right? So that means I risk more during a rejection block, or I risk more during a buy-side imbalance. Now, why is that? That's a great question. And that's something that we ask ourselves, right? So is the buy-side imbalance larger? Do I find a quicker reaction off of order blocks, right? Is my risk to reward, we think of the array matrix, right? Where do order blocks lie on the array matrix? Where do rejection blocks lie on the array matrix? Where do I find more success? Where do I place less risk when I'm using my model? And so we use a combination of all of the information and all of the data points that I've mentioned previous to this slide with this one as well, and then we're able to apply that to our model. So we're going to talk about just very shortly about trailing. And so when we're in a trade, we demand specific price action around the arrays. We look for continuation, right? So we look for, when we have a model, it's a specific set of rules or a specific set of steps that we see form around a price that is built around a specific narrative, right? So in this case, if we are bullish, this low also formed a 15-minute fair value gap. So what do we seek in price? For my model, this would be a CST, right? So we get a CST, imbalance, and as you can see, the body's respected. Price stayed above the consequent encroachment. So as soon as we get a CST above this candle, that retraced into, right, because this is the candle that took liquidity, this low here, we look for a CST above, and then at this point, based on my data tracking, this will let me know if I can trail or not. So demand specific price action is price respecting the mean threshold, consequent encroachment, etc. And so we use the lower time frame for trailing arrays because if price hasn't reached the objective, then institutional order flow will be strict. And this is on NQ and on the indices. I'm not too familiar with Forex price action, but I can tell you from my personal experience and all my backtesting that with NQ and ES, price will be strict with order flow if the objective isn't met. So I can expect these lower time frame imbalances and CSDs and order blocks to be respected, right? So this is all based on historical information and what I've been able to track using the previous slide, right? So it's also important to be objective on our time frame and be aware of higher time frame arrays that are developed during this price delivery that can be used for lower time frame retracements, right? So let's say, for example, this order block right here, why wasn't that respected, right? Because this was a 5-minute imbalance. So price is going to want to seek that higher time frame imbalance. So what do? We ask ourselves, okay, what do we want to see from price during this imbalance, right? And so something important that I think about pretty much on a daily and that I want to see from prices, it's when can we expect deep retracements versus continuations, right? So it's when bullish, when price expands from a consolidation that did not take sell side, then order pairing will be done within an imbalance created near the high of the range, or at least above 0.5 of the range, right? Because the idea is that during a consolidation, expansion, 0.5, we will see the order block creation. So what happens is that when we see an expansion without taking that sell side, then the interest remains above, and we will see the order pairing be done during an imbalance or an array on the higher side for bullish examples of the range. In the case where this example, as you can see, price did take sell side and then it took buy side and it retraced back into a discount. So when bearish, if price expands from a consolidation that did not take buy side, order pairing will be done at the lows or within an imbalance created near the lows. And that's pretty much it. If you guys have any questions, please let me know in the question section or general chat or whatever chat it is, and we will be able to discuss it. Thank you guys.